Today, I'm going to share 3 fast-growing dividend stocks that just announced dividend increases over this past week. First off, we have Mastercard, ticker symbol MA. They just declared a 76-cent per share quarterly dividend, which is a 15% increase from their prior dividend of 66 cents per share. And I've been saying for a while now that I think Mastercard and Visa are some of the best dividend growth stocks you can buy. They have a dominant market position and print money. Mastercard has seen their revenue per share grow at a 14.45% 10-year compound annual growth rate. Free cash flow per share is growing at a 14.5% 10-year CAGR, and they have an extremely high margin and capital-light business model where they don't require large capital expenditures in order to grow their business. As you can see this decade, they increased annual free cash flow by over $7 billion while barely increasing their capital expenditures. Both Mastercard and Visa continue to benefit from the tailwind of the entire world switching more and more to digital payments. So all this means that Mastercard generates a lot of free cash flow, and they use that free cash flow to reward shareholders with a growing dividend payment and large share repurchases. The 10-year compound annual growth rate of Mastercard's dividend is 16.86%. With this latest 15% increase, the forward-looking annual dividend payment for Mastercard is $3.04, which at current stock prices gives the stock a 0.58% dividend yield. So Mastercard is a very low-yielding dividend stock. However, Mastercard is always a low-yielding dividend stock. Since going public in 2006, Mastercard has never had a starting dividend yield over 1%. The highest ever was 0.94%. And there's 2 big reasons why that is. First off, their dividend is a very small percentage of their free cash flow and earnings. That makes the payment very sustainable. The free cash flow payout ratio is only 18.5% of free cash flow as of last fiscal year, and the highest free cash flow payout ratio in the past decade was only 24%. Based on net income, the current payout ratio is 19.28%. So while their dividend yield is low, their actual free cash flow yield has been higher over the years. But the biggest reason is that Mastercard actually always trades at a pretty premium valuation. And that's because they have such a dominant business with a wide economic moat, and they have fast-growing earnings. Since 2006, Mastercard stock has had a 12,500% total return. The 10-year total return for Mastercard stock is 540%. And while Mastercard's low-yielding dividend may seem like it does not make that much of a difference, the impacts of reinvesting that small dividend still makes a difference in your total return. If we take a look here, you can see the percentage change in stock price since going public was 11,300%, while the total return was over 1,000% more. On top of that, you get this small growing stream of dividend income that is only set to continue increasing into the future. So Mastercard's a stock that if you're looking for income right now at a high yield, that will not help you with that goal. But if you're optimizing for total return, both Mastercard and Visa will likely do well in that category, while paying a growing dividend that continues to increase year after year at a high rate. At Mastercard, the majority of their revenue comes from their payment network. And I know when you think Mastercard and Visa, you think credit cards, but they don't actually bear the direct credit risk themselves. Instead, they operate the payment network, and they partner with financial institutions to issue cards on their network. And they get various fees up and down that chain. But then they also have this growing value-added services and solutions category, which is currently 37% of their annual revenue. And since 2020, that has grown from $5.4 billion in revenue to $10.4 over the trailing 12 months. And the payment network is still growing as well, growing from $9.8 billion to $16.8 billion over the trailing 12 months. Oh, and if you're wondering what this large negative number is in their revenue, that's client incentives. And this is the money that Visa and Mastercard pay to financial institutions in incentives so that they stay and issue cards either on the Visa or Mastercard network. It's not exactly similar to, but you could think of it maybe in the same way as how Google pays Apple money to be the default search engine on Apple devices. Long term, though, this value-added services bucket will likely be a big point of growth for the company. And they just made new acquisitions to enhance that side of the business, notably Recorded Future. And that is notable to me because I was actually an intern at that company during college, and my future brother-in-law also works there. Other notable news for Mastercard stock is they just declared a new $12 billion share repurchase program, which will take place after they finish their current $11 billion program, of which they have $3.9 billion left. And this is another way that Mastercard returns capital to shareholders. Recently, they've been buying back around 2% of their shares outstanding every year. All right, so the number 2 high growth dividend stock that just increased their dividend is Waste Management, ticker symbol WM. They approved a $0.825 per share quarterly dividend, which is a 10% increase from their prior dividend of 75 cents per share. This is a company known for their reliable and growing dividend payment. And while their dividend increase has not yet been fully reflected in my data on dividenddata.com, the forward-looking dividend after this increase will be $3.30, which will end up giving them a 1.6% dividend yield. And this new 10% increase is actually an acceleration in their dividend growth. Their most recent increases have been around 7%. The 10-year compound annual growth rate of the Waste Management dividend is 7.18%. This is a quarterly payer which increases on an annual basis. The payout ratio based on free cash flow is 62.28%, and the payout ratio based on net income is 49.31%. So this is a sustainable payment. The company also repurchases shares around 1% a year. Revenue per share has grown pretty good lately at a 7.74% 5-year CAGR. However, recent free cash flow growth has been slower. The 5-year CAGR is 0.6%, and the 10-year CAGR is 5.93%. So far in fiscal 2024, they're on pace for one of their higher years in recent history for free cash flow. But that said, their overall cash from operations is growing, which may be why they feel comfortable about their dividend increase. But compared to something like Visa with very low capital expenditures, Waste Management has a little more at $2.9 billion in fiscal 2023. That lowers their $4.7 billion of cash from operations down to $1.8 billion of free cash flow. All right, so stock number 3 that just increased their dividend is TFI International, ticker symbol TFII. They just declared a 45-cent per share quarterly dividend, which is a 12.5% increase from the prior dividend of 40 cents per share. This is a trucking and logistics company whose stock has seen pretty good growth in recent years. They have been paying and growing a dividend since 2017, and that has started to get more reliable, and they're on a few years now of increasing on an annual basis. The 3-year compound annual growth rate of the dividend is 25%, and their most recent increases were 12.5%, 14.29%, and 29.63%. The forward-looking annual dividend is $1.80, which is a 1.3% dividend yield, and this is a very sustainable dividend as well. Payout ratio based on free cash flow is 18.6% based on fiscal 2023, and the payout ratio based on EPS is 23.99%. And in recent history, this has always been a very sustainable low payout ratio. And in fiscal 2022 and 2023, they have been repurchasing a large amount of shares. This is one of those companies where they saw their revenue surge massively following the pandemic, and they're working their way back up to all-time highs. But interestingly, their free cash flow has done very well lately. They just had an all-time high free cash flow per share of $7.56 in fiscal 2023, and at the current stock price, that would give them around a 5.5% free cash flow yield. Said another way, that would be an 18.2 free cash flow multiple. So of the stocks I showed today, TFI International has the lowest valuation while still paying a fast-growing and sustainable dividend. So to wrap this up, I shared the low-yielding Mastercard stock, which has had a very good total return. Then the slower-growing but reliable Waste Management stock with a higher starting dividend yield. It's done pretty good, but not anywhere near Mastercard. And then TFI International with high dividend growth, a lower valuation, but less of a track record when it comes to dividend history. If you found this video to be interesting, leave a like and subscribe to the channel. And if you want to use the stock research tool I showed throughout, it's available at dividenddata.com. There you can get a great source to do research on dividend stocks, whether it's high growth or high yielding stocks. Plus you can track your own dividend portfolio and your real earned dividends over time and get breaking dividend news on increases, decreases, and special dividends. And you can even get that filtered by stocks on your watch list and portfolio. So if you want to join Dividend Data, it's the best way to support the channel. Link in the description and pin comment. And all you have to do is find one slightly better stock and it more than pays for itself. With that said, thanks for watching and I'll see you in the next video.